The stock market is having one of the best starts ever to a year, but until recently it was missing one thing, a record high close. That changed this past week when both the S&P 500 and the NASDAQ hit new record highs. In this morning's U.S. Bank Economic 360, U.S. Bank's Senior Vice President Mike Denneman talks about how we got here and what it means for the market. He is with Business Courier's Market Engagement Director Kelly Snyder in the studio. Mike and Kelly.
Thanks, Peg. So, Mike, it seems like last year was a year of records, but not so much so far in 2019.
Absolutely. Yeah, it seemed like every time we turned around last year, we were talking about a new record high and then a new record high. In fact, some of the indexes, they set more than a dozen records last year. But then, yes, 2019, not so much. You know, all the talk has been about this record rally that we're on, as Peg said, one of the best starts ever to a year, but no record highs. And the reason being is that the decline was so significant in the fourth quarter that we've had a long way to come back to get to that new record high. Most of the record highs were set late last fall, and then the fourth quarter came along and you know, everything fell apart. So the market has been slowly climbing back up that hill. Finally, again, just this week, S&P 500, NASDAQ finally got back to the top.
So why the strong rebound?
Yeah, great question. You know, it's kind of a flip side almost of what went wrong in the fourth quarter. So we have to kind of remember that 2018 was a pretty good year for the market for the first three quarters. It wasn't until the fourth quarter that everything just unraveled. So, you know, worries then about the Fed, maybe they were moving too quickly, about the economy, maybe it was slowing down, corporate profits may be slowing down. So, you know, all that pushed the market lower, and then here we go to 2019, and all of a sudden we know, well, the Fed, they're on the sideline. And the economy, it's actually doing very good. We got a great GDP report on Friday. So all of those things that were worrying investors last fall, now they have not come to pass. And so that allows the market to rebound. Investors are happy now.
So what can we expect from the market as we keep going?
Well, yeah, exactly, right. And so that's the big question that's on every investor's mind. And really, we seem to be getting some conflicting answers on that. There seem to be a lot of observers who are looking at the same information, and whereas some will say the glass is half full, others are saying actually the glass is half empty. And so the glass half full is, you know, all those things we just mentioned a minute ago. The economy doing well, corporate profits doing well. People look at that and say this is a great environment for stocks. It should just keep on going. Whereas the half-empty crowd says, hold on a second, you know, all those things we were worried about last fall, they've not really gone away. They're just kind of on the sidelines, and they might come back at any time. But maybe we went from being too pessimistic to now we're too optimistic. So time will tell, of course, but I think a good approach is, you know, we should be, you know, appreciative that the market has bounced back the way it has. But at the same time, probably to be realistic, the market can't keep up this pace indefinitely, so we're just going to have to see how it plays out.
Great.